Good day, ladies and gentlemen. In this video I'm going to teach you how the market actually moves. Okay, so this is going to help you with two things in particular. It's going to help you in terms of taking your profit. You know exactly where to take your profits. It's going to help you in setting your take profit positions, okay, or where to take partials generally. Okay, that's the very first thing it's going to help you with. The second thing is it will help you with entering at the right level. Okay, so if you have an idea of how price moves, you can enter at the right level, and you can also place your take profit position at the right level. Okay, so basically let's get right into it. So price moves actually in a cycle. Price move in a cycle from internal liquidity, okay, from internal liquidity to external liquidity. Just follow, okay, follow. You are going to understand it. From internal liquidity to external liquidity. So it also moves from that external liquidity back to internal liquidity. So it forms this cycle of moving from internal to external, external to internal. Okay, so basically what is external liquidity? External liquidity are your highs and lows. All right, so your highs and your lows stand for your external liquidity, while your internal liquidity simply stand for your PD arrays. All right, which is simply your FVG. You have your FVG, you have your order block, you have your breaker block, etc. So those are your internal liquidity, or you can call them internal structure. So basically what happens is when you have an uptrend, for example, price moves like this, giving you an impulsive move, then it retraces. This retracement is usually to take internal liquidity. This is an I right here. This I stands for external liquidity. So now the market has taken the internal liquidity, it will seek external liquidity. That's why it goes above this I to continue the uptrend. But as it is going above this I, most times it's going to leave another internal liquidity structure, maybe a fair value gap or a supply zone or a demand zone. It's going to leave an internal liquidity structure which is going to pull back into, okay, since it has already taken out external liquidity, its next aim is to pull back into an external liquidity. As it's pulling back into that external liquidity, it's leaving behind, as it is pulling back into internal liquidity rather, it is leaving behind external liquidity, which is a I up there. So if it is done taking the internal liquidity here, it's going to come up to take the external liquidity. That's just the objective. It keeps moving from internal liquidity to external liquidity. From external, it will seek internal again. So the cycle continues. Then the question remains, if the cycle continues, why is it that at some point it reverses? So that's a very important question. So I'm going to give you an idea of why it reverses. Okay, it reverses for two reasons. Every price reversal is due to two reasons. The first reason is because it has gotten to a solid support level or a solid resistance level. So once price gets to a solid support level or resistance, okay, it is going to reverse. All right, now what I call support level or resistance level could be an higher time frame supply zone or an higher time frame demand zone. Okay, so it could be, you know, any solid level that has the potential of reversing price. You know that a supply zone will always want to reverse price to the downside, all right, while a demand zone we want to reverse price to the upside. You can also call that could be maybe an order block for ICT terminology. There could be an extreme level order block that once price gets there, it's going to reverse price. So on the higher time frame, price could have gotten to that level. So once it is at that level, it would want to reverse. So that's the very first reason why price is reversed. Because logically you would expect that, oh, if it's always seeking internal liquidity, then external liquidity, internal liquidity, then external liquidity, why then do we have something like this where it comes back down and changes trend? So that's the question I'm answering now. The very first reason is because it has reached a solid level that is going to reverse it. That's the first reason. The second reason is the one you should pay attention to. because this one is very easy to spot. Very easy to spot. I see traders making some kind of funny mistakes just because of lack of knowledge of this second reason that I want to give you now. So what's the second reason? While price is coming back to is moving from external liquidity to internal liquidity, sometimes it could leave behind a level of internal liquidity within its leg which is seeking internal liquidity. So if it leaves that level of internal liquidity, it implies that it can no longer get to the external liquidity point. So that level of internal liquidity will now push it down. I will explain. Just watch. Look at this. Let's say price is in an uptrend. It pushes like this, leaves a fair value gap, for example, which is going to be its internal liquidity. Then it seeks the internal liquidity by retracing, leaving behind a high which serves as external liquidity. Then it pushes up, breaking that high and taking the external liquidity. But as it is doing so, it leaves behind an FVG again, which it pulls into as internal liquidity. Then it goes up to take out external liquidity, right? Good. Now, as it has taken out external liquidity, it leaves behind an FVG, okay, which is going to serve as internal liquidity. So it's going to come from its high and seek that internal liquidity. Now, pay attention. While it is coming down to seek this internal liquidity, there's a possibility that the set of candles which move downwards to seek this internal liquidity could form an FVG. Let's say there are 3 candles in a row, okay, whereby the wick of the first candle did not intersect with the wick of the third candle, okay. So this now forms another FVG, which is now a bearish FVG on that price leg that is seeking internal liquidity. So that FVG is waiting for price to finish seeking this internal liquidity in order to bounce it back. So now price is done seeking this internal liquidity and wants to come back to this high, but as it is coming back to this high, it gets intercepted by this fair value gap along that leg. So it can no longer get to this high. So from there, this fair value gap pushes it down in order to take out this low which is created here. That is just the beginning of a downtrend. So as it is taking out this low, it is creating another FVG here, or other block, or whatever internal structure it wants to create. Then it's going to pull back into it, and that will push it to take this external liquidity, which is this low. Hope you understand. So if you are getting value from this video, please subscribe to the channel. That's the only thing that encourages me to keep giving you all this kind of information. Now let's see. I want to just give you some examples on the live chart quickly. Now price pushed in the upward direction, leaving behind an FVG, okay. Look at that FVG right there. So what do you see happening? Price seeks internal liquidity by coming down into the FVG, then leaving behind an external liquidity level which it takes out with this move, okay. Takes out with that move, leaving behind another FVG, okay. Can you see the FVG it left behind? Left behind an FVG right here, which is pulled back into, just tapped into it, didn't go too deep into it, then pushed up, breaking the high right there. So it continued up to this point, okay. Then at this level it was trying to seek internal liquidity, okay. It was trying to seek internal liquidity, which is around this region, here, okay. There's an FVG there, though it's very small, all right. So as it was seeking the internal liquidity around that region, an FVG was formed. I don't know if you can see it right here. There's an FVG right there that was formed. Let me use horizontal lines to depict the FVG. Horizontal lines to depict the FVG, okay. Let me copy this. Hope you can see it. So as it was coming to seek the liquidity, internal liquidity at this level, it formed an FVG which I've depicted with these 2 horizontal lines. Now the next point price we want to go to is external liquidity, which is here resting above this high. But as it is coming up to that external liquidity, what happened? The FVG it has left behind decided to intercept it. That's the beginning of a downtrend. So now that it's intercepted, we had external liquidity taken to the downside. Then price, we want to seek internal liquidity in form of this order block. So price retraced into the order block, seeking what? External liquidity again, which is breaking this low. So the cycle continues like that and like that. So you have a movement from external liquidity to internal, then from internal to external. Very simple and very basic. So I hope you've gotten value from this video, and please subscribe to the channel, turn on the notification bell. I'll see you in the next video. Thanks for watching.